Welcome back to another episode of Counting on Chazin. This is the video series that Chazin Company has created so that we can help nonprofits navigate in a better way so they can achieve their mission, vision, and values. We're really excited today to talk about effective nonprofit audit preparation. Welcome back, Jackie. That's kind of a long title.
Yes, it is. And thank you for the welcome. I'm happy to be here again.
Well, we are really excited. Just to remind you, if you haven't been with us before, Jackie McLaughlin is a client services manager with Chazin Company. She's been one of our star experts that we've had on counting on Chazin, because we pepper her with a lot of questions and she takes them in stride and really helps demystify a lot of things. And so it's just been a pleasure to welcome you back. So I've got to start with this big question that kind of frames up our conversation today. Why do nonprofits need audits?
Great question. Some don't. There's typically one of maybe three reasons a nonprofit will need an audit. So first and foremost is if they get any government funding, that government funder may require an audit. And sometimes that depends on the threshold of the funding that they receive. It should be in any grant or contractual funding paperwork that a nonprofit signs. So that's probably the biggest reasons. Secondarily, the majority of the states in the union require nonprofits to get a charitable solicitation license. And that allows them legally to go out and raise money. Each state has a different threshold of revenue for when an organization needs an audit. Again, if they want a charitable solicitation license. Now you have to have that to raise money. So when you go to get your charitable solicitation license in whatever state you're in, you need to look at that state's rules and say, at what point do I need an audit? And usually that's dictated by revenues.
Okay, so let's talk about that CSL requirement. And that's just a little bit of a diversionary topic before we go further. But my thought immediately when you said that was, look at all of us in the nonprofit sector that are now taking donations from folks out of state because of the digital portals and the ease with which we can get these donors to interface with us digitally. That's a pretty big deal, and maybe that's a topic for another time, but that needs to be filtered in through all this. Is that what you're saying?
It may be. And again, I would refer people back to their states because each state is different. We do have a client in Georgia, and they raise funds primarily through GoFundMe and social media. Their CSL is only in the state of Georgia. But again, beyond Georgia, that's something you need to go to each state's CSL website and read the requirements of that.
Wow. Okay. Well, that's a big heads up. And we might have to revisit this
because could be a very good topic.
It's a big topic. Now, the next thing that you have kind of illuminated for us is that there's a difference between an audit and a review. And sometimes we will hear that there's the audit and there's a review. They're not the same thing, right?
They're not. And I'm excited because that's a great segue from what we were just talking about. Okay. What I forgot to mention is that each state's requirements when you get a CSL vary depending on the revenue, which I talked about that. But some states may say, okay, if your revenue's over $1 million, you need an audit. If your revenue's over $200,000, you need a review. So it's a great segue into talking about the difference between those two levels of service. Both have to be performed by an independent CPA. And I stress the word independent because if you have a CPA firm doing your transactional day-to-day payables, receivables activity, they cannot do an audit or a review for you.
No way. It really has to be a whole nother a whole nother firm?
Correct. They have to be completely independent of you to be
Oh,
able to do an audit or a review. Now, there's other levels of service that they can offer that they don't need to be independent, but for an audit or review, they need to be independent.
oh my gosh. So that's involving like a whole nother level to this. This is why this is such a good conversation to have, because it's a lot more in depth than I think most of us realize.
It is. And if you do have a CPA firm doing your transactional things and you ask them to do an audit or review, they will typically say no because they're not independent, but then they can usually refer you to somebody they know who can do it for you. But an audit is the most intensive thing that you can get done as an organization. So an auditor is not just looking at your overall financial statements, but they are drilling into the details of those financials. They are saying, hey, you said you spent $10,000 on office supplies. I'm going to pick some random invoices that you coded to office supplies, and I want you to show me the invoices that support this. They get into that level of detail, and they determine where their detail is going to be based on their overall risk of the organization.
Mm-hmm.
One thing I want to point out, because I think it's a mistake that people think, auditors are not in the business to detect fraud, stealing, or misappropriation. They are not in the business to do that.
Okay, that's interesting, because I kind of would have thought that that went hand in hand with this whole thing.
No, it can. And if they find it, they have an obligation to report it, but they may not always find it. And there is an expectation on audit. Oh, we're getting audited. If anything funny is going on, we'll find it. No, there are two situations that will, if they're existing, will never allow an auditor to find fraud. And one of those situations is collusion. If you have more than one person colluding to steal money or do whatever they shouldn't be doing, the auditors aren't going to find it because people are covering up each other's tracks. The other thing is called management override of controls. So that's when you have a president or executive director who hands the organization their $10,000 personal Amex bill and says, pay it. Well, anybody down that chain of command, that's their boss, they're going to pay it. So if an ED were to do that, that's called management override of controls, and an auditor typically will not find fraud committed that way unless there's a whistleblower. So the 990, which is the tax return for a nonprofit, asks each nonprofit if they have a whistleblower policy. You're not required to do it, but it's a darn good idea. And if you have a whistleblower policy, then an auditor may catch something because an employee may come forward anonymously to the auditor and say, hey, I don't want anybody to know it's me, but this is what's going on.
You know, because you brought that up, let me ask you this sidebar question, if you will. If you are an organization that doesn't have a whistleblower policy, is that something that your accounting provider can help you with, or give you the template or something that's going to help you get the right thing in order?
Yes, absolutely.
Yeah, because I'm not hearing about this enough. I know that you brought this up in another conversation that we had with Counting on Chazin, but as I've been thinking about it, you know, this isn't really something that I've been seeing, and we do need to make sure that we amplify that message to our viewers. Let's switch gears a little bit and talk about this PBC, prepared by client list. You mentioned to me that this topic is one of the most popular topics on the chazinandcompany.com blog.
It is. But before I get into the PBC, let me quickly go back to the difference between an audit and a review, because your PBC list will be different depending on whether you're having an audit or a review. So it all kind of ties in together. So as I mentioned, an audit's very detailed, where the auditor will want to go in and see invoice support for things that you pay. For money that you've gotten through the door, they may want to see contracts associated with that, or checks that came in, or wire transfers, or whatever. They'll get into the detail. In a review, it's far less detail. A review is two things: inquiry and analytics. So what that means is they'll ask management a lot of questions. And then the other thing they'll do is they'll look at the data in relationship to each other. So they'll say, we see here that contributions went way up, doubled since last year, but your cash hasn't moved. What happened? So something like that is called an analytic. And a review is almost entirely just inquiry and analytics. So it's much less assurance than an audit. So an audit will actually say these statements are materially correct. If you get a clean audit, it says that. A review says, hey, we didn't find anything to lead us to believe that they're not correct. So there's a big difference in the messaging between an audit and a review, which is directly related to the level of service being provided. A review is a scaled down service. So
let me interrupt you really quickly. Would you say that the review is more in a narrative format, where it's going to be more, or it's still going to be a ledger kind of presentation?
Well, the auditors on an audit give an opinion, on a review they give a report. It's still very templated, boilerplate data that the auditors will give you. It's their behind the scenes being narrative versus like Excel spreadsheets. Right. And to that point, in the behind the scenes, a review will have far more narrative in their work papers, but that's not something that stakeholders see or their work papers anyway.
Okay. All right, thank you for letting me interrupt you, because I kind of popped into my head, and I'm like, I better clarify this. Okay.
Yeah. So the PBC list is very different depending on whether you're having an audit or whether you're having a review. So if you get an audit, a PBC listing is going to be far more extensive, and they're going to want to see your trial balance, your internally produced financial statements, any contracts you've entered into during the year, any large contribution agreements, any grant agreements. They're going to want to see all the paperwork for that. So what we do at Chazin Company, when we have a client we know is going to get audited every year, as they sign new contracts, we grab a copy of them and we have a little folder, audit folder, and we just drop it in there so that at the end of the year, we're not scrambling to go, oh my gosh, we have to get all these contracts. We get them along the way, which is best practices and less headache.
Yes. That's a great tip, because then you're just automatically
keeping there. Yeah. And you can, the electronic communication and work now, auditors tend to have a portal, and you can just take that whole folder and dump it onto their portal, and it makes your life a lot easier. So they will want to see anything contractually signed. Now, unless it's really insignificant, if you're signing a $10 a month utility agreement, no one cares about that. But the big money they'll want to see and they care about. Once they ask for some of those bigger things, and the PBC list can be quite extensive. Larger nonprofits may have 100, 120 items on their PBC list. It can be big. Wow. And that's just the beginning. You give them that in advance, and then they start doing their work. And then they say, hey, we see this office supply account that's $200,000. We're going to pick some samples, and we want to see the invoices to back up this office supply. Or they'll look at your payroll. Hey, we want to see all your 941s, which are your quarterly payroll reports to the IRS. And we want to make sure that what you have on your financial statement can reconcile to the 941s that were filed on your behalf. So just because you finish this PBC list doesn't mean it's over. It's only just begun at that point.
Wow. So I can see why this is such a hot topic, and that folks are researching this through. the Chazin Company website. It's really an interesting thing that I would imagine most people, unless they're part of that accounting and finance team, don't realize. You mentioned something to me before I asked my next question, and that was it's really important to make sure that you have all hands on deck during this time. What does that mean?
Well, so the top level management really needs to think about approving vacations around the time of really the fiscal year end. So a lot of nonprofits have June 30 fiscal year ends, and people want to start taking vacation. But here's the thing. I mean, your accounting department is really responsible for getting ready for an audit. However, if you've got budget managers who have vendor invoices that are sitting on their desks and they're just not approving them and getting them into accounting, that's going to mess up your audit prep work. So top management needs to be very vocal with budget managers, with the advancement or fundraising departments. They need to be very vocal and give these people strict timelines to submit all this data to the accounting department. And so it can be inconvenient when budget managers, fundraising, advancement are suddenly on vacation when accounting needs them the most. And similarly, if you have a June 30 year end, auditors will come anywhere between August, September, October, whenever schedules mesh. It's also not a great idea to approve vacation time for your accountants in September or October when your audit's going to be underway.
That's an interesting point. So let me get back to that. There is kind of like an audit season, if you will. That's when that's going to be occurring pretty much right after the year end closes, right? I mean, so that you're not doing this like 6 or 8 months down the road. You're really trying to keep it as close as you can to the year end.
You are, and typically auditors won't come on a June 30 till, let's say, September, because come July, the accounting department for the nonprofit is steamrolling into tying down those June 30 numbers and really preparing for that audit. So they're going to need a couple of months to adequately prepare for the audit. So that would mean the soonest an auditor is really going to come is maybe around Labor Day to give the team adequate time to prepare. And then at that point, it just becomes when the audit firm has room in their schedule to come.
Yeah. Okay, that helped me out because I don't think I realized that. Another piece of this that I want to chat with you about is what auditors are, looking for and determining. I mean, you had a really interesting thing of helping us to understand how they're going to go about this and the detail that they need and how that interface is going to work with a team. But you have four major things that are, if you will, and correct me if I'm using the wrong vocabulary, but almost like what the conclusion is. And you start by saying or using those two words, materially correct. So what does materially correct even mean? Let's start there.
Okay, so all good tax people use the answer, it depends. And I know nonprofits don't have to do taxes, but it depends is a great answer. So the word materially will be defined differently for every single nonprofit. So if you're a nonprofit whose revenue is $100,000 a year, $5,000 may be materially for you. If you're a nonprofit who pulls in 20 million in revenue a year, $5,000 is not going to be material. So the accountants, the CPAs like to use the phrase, at what dollar level would it sway a stakeholder's judgment? So and I'm kind of paraphrasing that, but if you apply that to my example, $5,000 on 20 million in revenue is not going to sway a stakeholder's judgment or a grantor's judgment or a donor's judgment. $5,000 error on 100,000 in revenue, that may sway a grantor, donor, stakeholder's judgment.
Yeah, I love that you said this because I never put it in that context. And you're absolutely right. It depends. So,
Absolutely.
so then you have financials are materially correct. That's the number one thing. That's one option.
Well, let me stop you there.
Okay.
Auditors are very specific. That's called a clean opinion. And again,
Okay.
all the words I've given you are very paraphrased. They're not accounting speak. So that's called a clean opinion.
Okay.
And auditors say the word materially because an audit is based on sampling and testing. So
Okay.
they can't say, hey, we know everything on here is totally correct. They can't say that because they don't look at everything. They look at a sample and then they extrapolate out. So that's why they use the word materially.
Interesting. Okay, now, so that is clean. And I would say if there's a pyramid, that's the top, that's the
Mhm.
best. Yay, team.
Yes.
Move on to all the other things that we have to do as nonprofits.
Yes.
Now, the next level, going down on that triangle, if you would, financials are materially correct, except for one thing.
Correct. And it may be one or more, but generally it's one. So you see this a lot in the for-profit world. And I'll give you a for-profit example because it's easy to understand. So in the for-profit world, there's different methods of depreciating your assets. There's your book method, and then there's your tax method. And so many for-profit companies will record depreciation on their books using the tax method. And that's just what they want to do. They don't want to convert for book purposes. So
Right.
in that case, an auditor may issue an opinion that says, everything looks materially correct and is compliant with GAAP, generally accepted accounting principles, except for depreciation is done on the tax basis, not in accordance with generally accepted accounting principles.
Got it.
And they'll only do that except for when that disagreement is immaterial. I mean, if it's big numbers, they won't do that.
Interesting. Just like
And
you said.
that's when an organization digs their heels in and they say, yeah, we hear what you're saying, but we don't want to do book depreciation. We want to do tax depreciation.
Interesting. Okay, now as we're going down this like imaginary pyramid and things are getting heavier at the bottom, number three is for financials are not materially correct. And that's got to be a pretty big red flag, right?
It's a huge red flag. No one wants to see that because the value of an audit is really having outside people look at your books and say what management is doing is consistent with GAAP, consistent with the principles of accounting, and can be relied upon. So if you get an opinion that says your numbers aren't materially correct, that's a deal breaker typically. Lenders don't like that. Grantors don't like that.
Yeah.
And usually most management will fix the problem so that they don't run into that opinion.
And so that was going to lead me to number four. Records were not sufficient to allow an audit. I mean, the reality is that's catastrophic on a whole nother level. You're probably dealing with an organization that has a lot of other problems because they have.
Yes.
It sounds to me, and correct me if I'm wrong. It sounds to me like the management hasn't even tried to interface with their accountants to even get the information needed to move forward.
Well, management's really dropped the ball on getting supporting paperwork. So that's auditors call that disclaiming an opinion. So they're not saying it's materially correct. They're not saying it's not materially correct. They're saying we don't know because we couldn't get the records to determine if this is materially correct or not materially correct.
Wow, and so pretty scary.
Yeah,
Pretty
that's not good either. And it also can be a situation where an organization does have a lot of records, but they don't have all of them.
scary.
So, maybe they have records for their expenses, but they don't have any records for their revenue, just as a gross generalization. And revenue happens to be one of the riskiest things auditors audit, particularly in the nonprofit world when you have restricted revenue, or sometimes that revenue needs to be deferred. So that's very risky. And if a nonprofit doesn't have the revenue records to give to an auditor, they may choose to say, we don't have enough data to say, yeah, it's materially correct. No, it's not materially correct.
Wow, amazing. I keep going back to what you said right when we started this conversation with you, and that is that magical folder that sits on your computer where you
Mm-hmm.
shuffle copies of things, because that I just can see this as being um, um, a mindset and an action of habit, so that you are collecting this information, which is pretty powerful. So we've talked about this major concept: audit versus review process. Um, the third party, piece of all this, the timing. Where does all this go? I mean, this is a lot of work, a lot of time, a lot of cost, a
Yes.
lot of stress.
Yes.
I mean, Jiminy Crickets, you're telling folks they can't go on vacation. you know? So, what happens? Where does this go?
It depends. So, so if you get government funding, federal funding, for example, you do have to upload your audit to a federal database. So that, and again, it's over certain thresholds of federal funding that you have to do this. So that's the most obvious place that it goes. If you have debt with lenders, whether it be a line of credit or just a big loan, your lender may require an annual audit. Recently, one of our clients who has a processor for credit cards, which most people do, the processor wanted a copy of their audit, which is a new one for me. I've never seen that one before. Yeah. And then, as I said, grantors as well may require an audit. So there are some requirements that it would be distributed to. If you have a CSL, you're going to have to upload that to the charitable solicitation license website, possibly in your state. Again, read your state's rules.
Mm-hmm.
So it goes to all of those places. Aside from that, typically it will definitely go to the board. They need to review it. And an interesting note, the auditors are required to have a private meeting with the board of directors, or at least the audit committee or finance committee, in which the executive director is not present, so that the auditors can have the opportunity to tell the board, we found these problems, we got pushback, the ED wasn't cooperative, whatever the case may be.
Wow. Okay, so that's an executive session issue.
Yes.
And that's fascinating, because I'm going through my mind here, ticking through. Um, I don't know if I have been a part of a board that has actually done that. It always seems like the executive director is in on that. So I'm gonna have to think back about that. But that's fascinating. And yeah, that's another control. That makes total sense.
Yeah.
I don't know
Yes.
if we're always doing that though.
Well, if you're on an executive committee and your board that you're on has an audit committee or finance committee, they're probably doing
Okay.
that.
Okay.
Hopefully they are. And that's an opportunity for the auditors to really tell the board anything they should know. Now, thankfully, I can happily tell you, I've never been a part of one of those where the auditors haven't said good things about the we had no problems, everything was great, we agreed on, they gave us what we needed. Typically, that's how it goes. But it is there in case you have an executive director who's not so accommodating, maybe trying to hide some things. That mechanism is there.
Yeah, well, it's an important thing, and this is part of why we're doing it. I think one of the things that's been so interesting to me, and as we finish up our time with you today, Jackie, you've really illuminated the reality of an audit and a review. It's doing a lot more than maybe we even realize. And I'd love for you to kind of finish up this conversation with us today about talking about that impact. I mean, I'm going to use the word impact because of all the different people that ultimately will benefit from this. And if you could kind of give us some of your thoughts on that.
So in a way, it's kind of like when you're a parent and you go buy a car seat. And your car seat is one of the most important things you buy as a parent because you want to ensure the safety of your child. And you look for a car seat that has some stamp of approval on it. Now, I haven't needed a car seat in years and years, so I don't know what that stamp of approval is. But there are certifications or something on car seats that parents look for. An audit does for financial statements what that certifying body does for car seats. And the impact is it makes donors, grantors, state or federal agencies breathe a sigh of relief. Okay, some outside objective third party who's got no reason to care one way or another came in here, looked at this financial data and said, yes, it looks materially correct. That then gives donors, grantors, lenders more comfort to say, okay, I can feel good about giving my contribution to this organization because I know that they're using it effectively. And I know this because I've looked at their financials and I can trust their financials because they've been audited.
Interesting. Yeah, and I think this is a magical way to think about it, because it also, if you do have this mindset, it seems like you and your team can be a lot more invested and not look at this as penance or drudgery, but to say, look, this is ultimately, if we use this information right, this is only going to help us grow and create, stronger impact, which is what we're all about. So
I'm thrilled you brought that up because no one likes auditors. And by the way, I spent 7 years as an auditor, so I've been on that side of it as well. And the reason no one likes auditors is because it does add to their workload preparing for an audit.
sure.
But having spent 7 years as an auditor, I'll tell you, auditors are nice people. They're not there to argue with you. They're not there to make you look bad. They're not there for any of those awful reasons. Now, where nonprofits get into workload problems, and I love this point, back in 1984, a nonprofit used to record contributions in this certain way, A, B, C, D. And that's how they proved it to the auditors. Well, the auditors don't know any different. So they come back the next year. They say, hey, we want to see your contributions. Here's how you gave it to us last year. And so the nonprofits go, oh, okay, I got to give it to them in the exact same way I gave it to them last year. So now we're in 2022 and technology's changed. Everything's changed. They're still giving it to the auditors the way they did in 1984 because they think that's how the auditors want it. No one ever, very few people stop and say to the auditors, what are you trying to prove by asking me for this template or this format? What are you trying to get at? And then the auditors will say, oh, I'm trying to get it to make sure contributions are recorded correctly. Well, I can give it to you this way, this other way that will take me an hour to give you instead of a month to give you. Do you think that this new method of giving it to you will work for you? And typically they'll say, yeah. And if it saves you time, it saves me time.
Right. Well, that's just it. It's the whole journey of the process and the stewardship of that process.
Yes.
Fascinating.
So that's probably my best tip of the day is when they're asking you to prepare these voluminous, laborious schedules, talk to them and see if the two of you can come up with an easier alternative way to give them the same information.
I love it. Well, I don't know. You've given us a lot of tips today that have been pretty right on and given us a way to reframe this discussion of how we prepare for an audit. Jackie McLaughlin, CPA, Client Services Manager, Chazin Company. You are just a marvel. I'm really always so interested in your take on things and how you can simplify something that a lot of times can appear to be daunting or even frightening, and you kind of push it all together for us to make it a lot more achievable. And at the end of the day, if we can't navigate some of these best practices, we can't achieve our mission, vision, and values as nonprofits. So we've got to have these conversations. We have to be, more educated about this. So thank you so much.
It takes finances to change the world,
Mm.
whether people like it or not. It takes money, and you have to have good stewardship of your money, and accountants help you do that.
I love that. I love that. Jackie, that is a great way to end another episode of Counting on Chazin. We're really here with a lot of information. You can go back to countingonchazin.com or to chazinandcompany.com. We have so much information, so much content. It's being updated and added to, and it will really help you to navigate these processes that all nonprofits need to be taking a look at. Again, I'm Julia Patrick, CEO of the American Nonprofit Academy. I've been delighted to have you with us today on another episode of Counting on Chazin. Thanks so much.
Thank you.